Okay, good morning everyone. Welcome to this showcase session for the Digital Sandbox Pilot. I'm Nick Cook, the Director of Innovation at the Financial Conduct Authority, and it's my pleasure to welcome you and to compare this session focused on the use case of consumer vulnerability. Can we go to the next slide, please? Over the previous 10 weeks, 28 teams have taken part in the Digital Sandbox Pilot. The pilot's been focused around 3 use cases relating to issues that have been caused by or exacerbated by the coronavirus pandemic. 10 teams have been developing solutions relating to the second challenge, that being around improving the financial resilience of vulnerable consumers. Now, it's the case that all consumers are at risk of becoming vulnerable at some point during their lives. Some are vulnerable for lengthy, extended periods. Others experience more temporary or short-term vulnerability. And we expect that firms should treat customers fairly. And in order to do that, they need to respond to the needs of all consumers. But we expect them to take particular care to ensure that they meet the needs of consumers at the greatest risk of harm. And that includes vulnerability to financial shocks and things like that. So COVID's been a bit of a twin crisis, actually. It's been both a health crisis, clearly, and my thoughts are with you and yours as we all battle through this difficult time. But it's also been an economic crisis. And unfortunately, like many economic crises, it is often the most vulnerable who are hit hardest during these times. And just to give you a little bit of a sense of how the pandemic has deepened and worsened vulnerability for many people, we see that approximately 4 million additional adults have experienced characteristics of vulnerability during the pandemic when it comes to financial vulnerability. We know that over 1 million people have lost their jobs, and a total of around 9 million have seen some fall in their income, be that furlough, reduced hours, pay cuts. We also know that around 13 million adults think that they will struggle to make ends meet in the next 6 months. And quite shockingly, about 5 million adults in the UK say they are likely to use a food bank in the coming months. And many of these are indeed the youngest adults in our society, the 18 to 24 group. We've also seen a very significant increase in the number of people using debt advice and debt management services. Around 1 million adults have used one of those services for the first time during this pandemic. And again, we see that when we look deeper into that data, it tends to be the younger adults in society, the under 35s. And regrettably, it is the Black and minority ethnic members of society that are even more likely to be included in those groups, requiring debt advice, seeking assistance with their money during this very difficult time. So resilience and vulnerability are issues affecting millions of people. And today's event is an opportunity for the teams to showcase some of the solutions they've been working on to try and address some of these important needs. I think you're on the right slide, so this is great, thanks. So what is the Sandbox? The Digital Sandbox is the result of a partnership between the Financial Conduct Authority and the City of London Corporation, together with numerous financial services, technology and academic collaborators who have come together to try and create a new testing and development environment to support innovation in financial services. We know from our engagement with RegTech and FinTech firms that often one of the biggest challenges is taking an idea from a proof of concept into proof of value and demonstrating how it could be applied in the real world. And we often hear that access to both data and access to expertise are some of the most profound barriers that entities face when they're trying to scale up and develop and prove out their innovations. So we collectively have sought to address these challenges, or at least have a first stab at doing so, in this pilot phase of the Digital Sandbox, which we hope will act as both a catalyst and an accelerant for desirable innovation in financial markets. Next slide, please. The Digital Sandbox in its pilot form has a number of features. There is lots of further detail on this on the Digital Sandbox Pilot website, but in brief, just to give you a bit of an overview, there are a range of high quality data assets within the Sandbox environments. These are both synthetic assets that have been created for the purpose of these experiments, and various anonymized real world data sets as well. And again, a thank you to those entities that have helped create those data sets and indeed have gifted and lent their data sets into the pilot. Within the pilot environment as well, there is an integrated development environment, a cloud native infrastructure to enable participants to develop and test their solutions. There are a range of APIs, I think in the order of about 300, 350 from fintech, regtech and other vendors to allow some plug and play development and to aid in the development of more interoperable solutions. And then there's also an observation deck, a space for interested parties to witness and observe the in-flight development and testing. And then kind of linked to that, a collaboration platform and a space for free communication between the teams and observers and mentors. And I should just take this brief moment to thank those who have supported, mentored and advised the teams during this pilot phase of the sandbox. Thank you very much for your contributions, your expertise, and the commitment of your time is very much appreciated. Next slide, please. So what's been happening? Teams have had about 10 weeks to develop their solution. And I do note those 10 weeks were also over Christmas and the New Year period. So maybe 10 weeks is a slightly generous description of how long they've had. We've seen hundreds of user accounts created on the platform. Over 5,000 unique visitors have engaged with the website over the past couple of months. And several hundred of you have signed up for what are set to be 3 showcase sessions. This is the second of 3, the third is tomorrow. We've also had a number of mentors, I mentioned those briefly already, who've been supporting the teams, several dozen of those that have come forward and helped teams with technical, regulatory and other advice. And we've seen very lively use of both the collaboration tools, the communication tools, alongside several 100,000 calls on the APIs and various other uses of the infrastructure and the technology that we've made available. So it's been a lively couple of months. Next slide, please. Today, each team, and there are 10 of them, each team will have 10 minutes in total. They will have 6 minutes to present, after which they will be rather cruelly silenced, and I apologise for that. And then we'll allow 4 minutes for Q&A. Please add your questions into the chat bar on the side. I'll try and ask the teams a selection of those, and any we don't get to during the 4 minutes, we'll ask the teams to respond to in writing in the sidebar as best they can. We're going to run 10 demos back to back, which is going to be quite an ordeal for everyone, so make yourself comfortable, and I hope you enjoy and get to engage with the developments and the solutions that the teams have pulled together. So we're going to make a start without further ado, and I believe the first up is an entity by the name of PrinSIX. Over to you, please. Thank you.
So, thank you everyone for your time. Let me explain what we've been spending our time doing. Firstly, can I thank the City of London Corporation and the FCA. We found the experience very helpful. We found the experience helpful because of the connections and the network it opened to us of experts in this field, so we could test theories and ideas. Let me just move on. So what were we looking at? Specifically, what we were looking at is what's the limit of the digital journey? Where do they stop? And where do people have to get involved? Where do you have to start involving a human? And what practically does that actually mean? How does that work? And what is the nature of that intervention? And can we make a difference there? Can we contribute to that? And just to remind anybody who hasn't seen this, or when we did the first demo day, the 4 key components of our platform is dynamic journeys. These are journeys that adapt, and so you can create very personalized journeys and onboarding journeys for applicants. This is behavioral insights, so every part of the journey is tracked, and you can see where people are on a real-time basis, and you can respond to those behaviors. These are code-free, and so you can configure them, and you can create very rapid changes. And these are testable. You can do split tests, and you have multiple journeys testing, so you can have controls and you can have alternative journeys. So let me tell you some of the initial takeouts. I'm going to tell you the answers. I'm not going to make any arguments of why I concluded this. If you want to learn about that or talk to me about that, connect with me over LinkedIn. I'll be delighted to have that conversation. Firstly, today's onboarding is very much, when we talk about it, we talk about it between apply now and you've been approved. That was very much my mindset starting this process. And it's very much about when do I as an organization need to speak to you as an applicant. That's very narrow. It's too narrow. Actually, the journeys of tomorrow should extend before beyond you've been approved. They should look beyond there, because you'll have a more open conversation, because people aren't moderating their behavior to get approved. You can understand more about them, and you can behave in a way as a firm that can reflect certain vulnerabilities that might be more willing to share with you. And it's a two-way conversation. You should be aware that actually the customer or applicant might need to speak to you, and their behaviors might indicate that. So you should facilitate that. I'm not talking about just a floating chatbot. I'm talking about proactive reach out to customers and saying, actually, can I help you in that part? We looked at the vulnerability of triggered by financial resilience. The conclusion is that those are best done digitally, because digitally allows evidence-based. And when I say digital, I don't mean just UX journeys. I'm talking about credit data. I'm talking about open banking data. So should be evidence-based. They should be comprehensive, and actually customer interactions for the economic risk are pretty unreliable. Talk about other vulnerabilities, that's a very different situation. And it's a much more nuanced position in which a combination of digital and human contact is the value and that's how you should cope with those things. But it needs to be targeted specific individuals. And so for all of this view, yes, PrinSIX can help. Through those four components, they can add real value to this situation. Let's look at mixed journeys, though. That's the real challenge. So the positives is actually vulnerabilities are well understood. Everybody I spoke to understood what those potential vulnerabilities were. They understood what those potential poor outcomes were. And they all had huge a number of ideas around what could be done to potentially mitigate all of those. There's this emerging concept of behavioral economics. I only scratched the surface, the nudge theory, okay? But it's clearly growing at a pace across regulators and across large firms that can be very powerful in terms of how you deliver journeys that are good for customers. And there is evidence that actually you can see flags in historic data and past data and behaviors. There is evidence that there are flags that show potential risk of vulnerability. The negatives are there's little evidence of best practice. Everyone's got ideas, but no one's tried them and proven how they should work. There's a general mindset, a continuation of this one size fits all, this is the journey. And that drives a binary conversation around everything can be digital, or no, you need to speak to a human in every circumstance. And although you can see flags that flags risk of vulnerability, it doesn't actually address the vulnerability. It doesn't provide any clue around what do you then do. And there are constraints today. There are constraints today, which is change is slow to implement, so it's hard to test. And you can only change things one at a time because you can't do multiple journeys. So you have a sequential test process. And so changes impact large populations. And so the reality is they're commercially high risk for firms. And so firms are naturally disincentivized from doing a lot of innovation in this area because they worry about the large population who aren't vulnerable being affected by finding the small population that are. But we found one thing that I'm really excited about in terms of how PrinSIX can really actually make a difference in this piece. And of those four components is the ability to test and concurrently test multiple journeys. And it allows you to start getting evidence of how innovation can make a difference. Those ideas that everybody's got, you can put them live. You can do parallel tests, see what drives better customer outcomes. You can target them towards small cohorts. You can do them across multiple devices, and you can do them at a minimalized commercial risk to firms. And because it's configured, not coded, you can do very rapid innovation, very rapid cycles, turning and implementing different journeys. So the learning cycles are short.
Hi, Julian, sorry to interrupt, just giving you a time check here.
Okay, thank you.
Yeah.
And journeys can give you actual insight, and the cost is low and undisruptive. So finally, very quickly, out of this, what I would love to do is I'd love to find, I would love to find, get lenders, regulators, specialists, interest groups, us, with some funding to test this. Let's put journeys live through collaboration and start getting true evidence of what are good ways of combined journeys. Thank you.
Julian, thanks very much for your presentation. 6 minutes, brutal, I think I would say, but well done, and thank you for taking us through it. You spoke a bit about the vulnerabilities that are easier to address and deal with. What do you think success looks like then? In the event that you develop these more bespoke journeys, what's the consumer experience of that? What's the consumer benefit of that? And can you talk to us about how that sits alongside the costs of firms implementing that? So can you give us a bit more of a rounded view of what this delivers for the end consumer?
Yes, so I think that what good looks like is that as you see flags of vulnerability, you can explore them, but you don't put everybody through that journey if there's no flags of vulnerability, because then, so you target your effort and you explore specific on specific individuals who are higher risk. So you identify the risk and then you create journeys specific for them. In terms of the cost of implementation, if you do it on a one-size-fits-all, is the impact it has on the population that isn't vulnerable. Things like acquisition costs go up, and then the other cost is development cost. IT overhead of doing change is always really, really hard. I think what good is you create, and I think this is where we help, you create an environment in which firms are encouraged, and actually they're not penalized for innovating, for changing, that they can actually proactively innovate without always being worried about, am I going to damage all my commercial performance? Am I going to impact all those customers that show no signs of vulnerability because I'm trying to deal with the small population that I'm concerned about?
Thank you. We'll take one more question, one from Ewan in the sidebar. What do you see as the biggest barriers to adoption of a PrinSIX type approach? So you spoke about some of the barriers of the current approaches and what makes it difficult. What do you think might be some of the barriers to adoption of this model?
I think the current model where you hard code a journey is so embedded in everybody's thoughts that actually taking this different approach clearly is a kind of education process. I think it's new, and anything new takes time to understand. And so I think it's the level of innovation, and so we have to find people who have an appetite to innovate, and obviously regulatory institutions like everything to be locked down and stable. So I think there's a different attitude around compliance and regulators to have fast-moving, changing circumstances, but in a safe way.
Julian, thank you very much. A call to arms at the end there from Julian for various participants. Please reach out to him if you'd like to know more about the solution. Julian, thanks for your time this morning. I appreciate that.
With 24 million adults in the UK now showing at least one sign of vulnerability and 12 million struggling to pay bills, loans and credit cards off this year, let's not beat around the bush. Things are tough for a majority in this country. These issues existed pre-COVID, but the pandemic has shone a spotlight and exacerbated the need to strengthen the financial health of those that are overstretched, financially vulnerable and in need of better control of their finances. I'm Craig Buchan, the founder, CEO of Qpal. We're a Scottish fintech currently working on solving the challenges around financial well-being, and we believe life can be made a little bit easier for those that stress about money. We came onto the Digital Sandbox a few months back, anticipating that we would build a direct-to-consumer application, similar to the personal financial management tools that exist on the market today, such as Yolt and Money Dashboard. But credit to the Digital Sandbox and the mentors in particular, they pushed us to think differently about routes to market, the pitfalls and challenges of building and scaling B2C products. And critically, they shared their experiences of issues that exist in the workplace environment for employees. So we dug in and done some research. $1 trillion wiped from the global economy in lost productivity every year as a direct result of anxiety and depression in the workplace. It's more than alarming. How have we as a society let things come to that? But more importantly, what can be done to counter it? Digging deeper with some of the research, we came across a number of studies that showed at least 67% of employees are faced with financial stress. Clearly huge numbers when across the working population, both domestically and internationally. These money worries can result in sleep deprivation, anxiety, loss in concentration, or motivation. The resulting impact being poorer mental health for the employee and a drop in workplace performance and output. So the question then became, how do we help vulnerable employees take better control of their finances, and how can we help them service existing debt more efficiently? We've been successfully validating our open banking concept with corporate firms since the turn of the year, as well as engaging with organisations such as the Money and Pension Service and the charity organisation Money and Mental Health to learn from their experiences directly on the front line to help shape our product development.
Craig, your slides are moving to the side. Sorry. Yeah, that's better.
Oh, I think we had that problem the first demo day.
They're moving again.
Oh.
That's better. Yeah. All good.
Okay, no worries. Yeah, financial stress and mental health in the workplace are intrinsically linked, but employers are yet to truly tackle the root cause with limited initiatives around financial well-being out there in the market. So we figured there has to be a big opportunity to partner with employers and professional services firms to strengthen financial health of the workforce with technology. So in terms of what we're building, version 1 is pretty much a cross between a PFM and a robo-advisor and centers around a digital assistant that helps users manage their finances better, service existing credit card debt more efficiently, and automate financial advice when the user needs it. We're working towards POCs in the spring with our partners and look forward to getting the solution into the hands of those that need it most as soon as possible. And as for the team behind it, we founded Qpal back in early 2016, originally developing payment technology to support the transition to a cashless society. We ended up out in the Middle East, partnered with Visa and built mobile wallet, merchant point of sale, and financial data solutions. But towards late 2019, we decided to pivot the business away from the Middle East, away from payments, and back closer to home. However, the experience gained down in the world of payments has definitely, allowed us to dive head in and kind of solve this problem around financial vulnerability with the experience we've gained thus far. So we are Qpal. Thanks for taking the time. Sorry about those slides messing up. I'd love for you to join us on our journey of strengthening the financial health of the overstretched and vulnerable in society. And happy to leave things there, move on to questions, and really open the dialogue with anyone that's perhaps working in the financial wellbeing space or anyone that's keen to learn a little bit more about what we're up to. Thank you.
Thanks, Craig. I'll kick off whilst others come up with some questions. In terms of the data that you need in order to sort of provide these views and these next best actions, do you see that the sort of data ecosystem in the UK and the existence of open banking is sufficient for the kind of metrics and information you require, or is there something else that customers need to be able to put into the tools, or employers need to put into the tools to give that fully rounded and fully informed picture of the customer?
Yeah, no, great question, Nick. For version 1 and certainly version 2 of what we have in the roadmap, absolutely, the access to current account and credit card information, that's really the crux of what our solution is underpinned on to begin with. But absolutely, we want to be moving further into the direction of open finance. So how can we leverage and help users better manage their mortgage, better understand loan products, better understand pensions? So with that, there is still more work to be done within opening up that data ecosystem. There is ways and means to kind of build solutions around that, but it's fair to say that the ecosystem hasn't developed at the pace that the current account and credit card ecosystem has developed when it comes to open banking. So we're confident that whether it's through regulation or whether it's just innovation in that space, whether the open banking platforms that have already connected APIs, through current account and credit cards, whether they begin to kind of grow their portfolio into other financial product offerings, then we can ride the wave with them. But certainly for the next couple of years, in terms of what we have planned, we're comfortable what we can capture through data at the moment.
Thanks, Craig. We've had a couple of questions about the role and interest of employers. Ben asking for clarification on is this B2C or B2B2C, and Hoss asking the level of interest that you've seen thus far from employers in this kind of innovation.
Yeah, I think looking at what employers have done, particularly over the last 12 months, there's been some great movements in terms of large employers taking more of a proactive role in terms of employees' well-being. Whether that's through giving access to tools like Headspace or Calm, around the calmness element, or whether it's running virtual yoga sessions. These are all good steps in the right direction. But I think let's not beat around the bush here. They're simply pain relievers rather than identifying what the root cause is. And I think that from what we've seen through the validation we'll be doing and with the POCs that we've got coming up, there's now a clear desire from employers to actually look at financial well-being, because they've now realized that the financial stress is actually what's causing the mental health issues, rather than just we can maybe get someone to calm and maybe work through some some meditation techniques for which maybe gives them a couple hours respite, but never really tackles where the underlying problem exists. So that's certainly been positive so far. And there has been I've got another slide here that I was kind of prepared in terms of what we've seen. There is a couple of companies doing stuff when it comes to B2B. Salary Finance have tried to kind of roll out initiatives to maybe give access for employees to get their salary maybe 3, 4, 5 days in advance. You've got Nudge, who've got a lot of kind of B2B corporate clients that they're sitting more on the kind of the financial education side. They're giving users a little bit of kind of top tips to save on your mortgage, not really dialing on a unique individual customer's finance basis. But there are initiatives, and we have seen strong engagement from employers with the likes of Salary Finance and Nudge. So the appetite to do stuff around financial is there. It's just that perhaps the tools haven't quite been delivered in a way that they feel that can drive most value into their employees yet.
Thank you. I'm looking for a cue on how we are on time. I will assume we have time for a quick answer to one more question.
Sure.
What have you found to be some of the indicators of financial stress and vulnerability? Are there any lead indicators? I mean, this may be your secret sauce, so perhaps there's a risk in revealing it, but anything you can share with us about indicators of financial stress and vulnerability? Yeah, so it's very interesting. Julian touched on it earlier on. Identifying the vulnerability is actually one of the hardest things. The clear, on a clear high level, it really does boil down to stable, full-time 40-hour week or 40-hour contract versus gig economy. That seems to be, particularly through these kind of more volatile times, has been one clear indicator that someone may be at more risk of becoming a vulnerable individual. It's not black and white, and I think that's where it becomes a little bit more difficult. And particularly what Julian touched on in the presentation earlier is identifying individual vulnerability touch points is so key to getting solutions like this into the hands of people that truly need it, rather than people that are voluntarily engaging with a solution. It's actually reaching it, getting into the hands of those that truly need it. Craig, thank you very much. Apologies for misintroducing you. Thanks for your presentation. No, you're okay. No, thanks, Nick. Cheers. And just a quick one from me. Thank you also to Therese and Toby. I think the way that we've run the sandbox has been first class. So thank you guys for all the work. It's good to hear. Thank you, Craig.
Stuck at home during the holidays, my siblings and I would play Monopoly for hours. We followed all the rules to the letter except the one that ended the game. You see, when unaffordable rents and unforeseen costs inevitably resulted in you running out of money, someone would slip you a 20 and the bank would offer you a loan to buy King's Cross Station. Now, we weren't fiscal policy prodigies or game theory wizards. It just seemed like running out of money was a problem we could solve together. Why would we end the game when we could change the rules to be less cruel? We don't have to scroll very far to see evidence of cruelty in the UK. Here, the top 1% owns 25% of household wealth. £20 a week is what 500,000 people call a lifeline, while another 500,000 think of the same amount and recall their favourite brunch line. 50% of us are at real risk of financial vulnerability, and yet We accept organizations who care little about vulnerability. They have rules that say, serve only who can pay and value only what is priced. The best responders to financial vulnerability are not banks, not the government, not buy now, pay later. The best responders are our friends and family because they are the ones who care about us. When we're struggling to make ends meet, informal borrowing is fast, convenient, flexible, and to people with low or irregular incomes who are seen as too risky for our banks to lend to, getting a loan from a friend is a much more affordable option. But borrowing money from friends and family also comes with a distinct set of problems. Young people report feeling uninformed and unclear about what's expected of them. Whether lending or borrowing, they report feeling uncomfortable and even unsafe. They avoid talking about money because they don't want to give the impression that money is more important than friendship. So people lose money and they lose friends. And it happens over and over again because chronic financial stress creates chronic relationship stress. Our support networks weaken, our mental health suffers, and those communities and individuals that we don't serve or value find their financial and social capital in long-term spiraling decline. Flank enables people who have borrowed money from their friends or family to manage and repay their loans in a way that's accountable and safe. We work with young people on low incomes to build confidence in themselves and confidence in each other. We do this through features such as a shared progress tracker and affordability monitoring and feedback and in-app messaging. Growing trust is our guiding principle, the key that unlocks compassionate credit for communities that need it most. To make an impact, we need to take urgent action. In 2019, young people collectively paid £420 million extra to access credit in formal markets, double what they paid in 2016. But it's not enough just to remove an extra price tag. We want to see people able to respond to the needs of their friends, building resilient safety nets and sharing in long-term wealth. The Digital Sandbox was a fantastic opportunity for us to better understand our customers and the nature of informal borrowing within communities. We learned about our customers by using our UX work to build hypotheses around their attributes and transaction patterns, and successfully validated about 80% of what we thought we knew. We learned about informal borrowing by identifying peer-to-peer transactions before asking which transactions were likely to be informal loans. Then we built a picture of community around these transactions. We brought these insights together to model the financial resilience of our customers and deployed our model against some of the APIs. Throughout the process, we met some amazing experts who were really excited by the work we're doing, and we're energized about where these discussions will lead. There were also people that we didn't quite get to, and we'd love to meet you too. Our next step is to take our MVP into development and secure the funding and feedback to fuel further learning. Flank's innovation and insight is a source of optimism in the face of a problem that not only hasn't been solved, it hasn't been properly understood. And we think that's a great reason for you to support us. Thanks.
CJ, thank you very much. An emotional and passionate pitch, and you've touched on a lot of really important societal issues. I guess what I'd appreciate is if you could expand a little more on what you think the solution looks like. So you're giving us a sense of how you'll know the solution's working in terms of longer term resilience, in terms of less awkwardness. But what are some of the components of the solution that addresses this problem? You talked about an MVP. Can you explain that a little bit more for us?
I can try to explain as much as is not like currently under wraps, because I think
fair enough.
So basically, the features that we've highlighted are basically a shared progress tracker, where it's basically a shared ledger where people can see where they stand on the loans that they owe each other, which we think is super simple, but actually doesn't exist between people at the moment. We hear really funny stories from our users where people actually, like in one case, had a scroll on the back of their door where people had where that person had marked their debts and the people that owe the money as well. We also, for example, think it's really useful to have in-app messaging in a platform like Flank because communication is one of the biggest problems that people generally encounter, and that leads to avoidance and loss of friendship. And we think that strategically it makes sense to have something like an in-app messaging platform because we tend to have really strict associations as consumers about which communications need to happen where. So for us, it really makes sense that we need something like bespoke that would support people to essentially like talk about a very hard subject for them.
Great, thank you. You've had some Q&A in the sidebar as well. I'll pick a couple of them. So
thank you.
Bit of some questions about the extent to which there's data that shows how regularly family and friends actually do formally request repayment, and whether that is something that occurs or whether most of these things do sort of lapse. You know, is there a viable lending and repayment sort of market? I guess to some extent is probably where the question's going. And then a linked question from Toby, which is, you know, to what extent Flank would play a role in trying to facilitate that repayment, or what role would it play in the event of non-repayment? So I guess a little bit more on that, if you could share some of your thoughts, please.
Yeah, so what was really interesting that we found in the sandbox was there was a high degree of peer-to-peer transactions. But in terms of the loans that we detected, it was actually quite small. So that really went against the data that we found through our UX research and through the ethnographic work that we've done, which really shows that these loans are happening at quite a high rate, and they're also happening at quite large amounts. And the ability to kind of rely on these loans actually really, really benefits people with low incomes or irregular incomes. And it's something that actually people with high incomes can disproportionately take advantage of. For example, I know a lot of people, like a handful of people that have borrowed money from their parents just to buy a car, and they've quite comfortably paid it back. So it's a really different situation from the situation that we're talking about, where people are borrowing money for groceries or borrowing money for bills or rent. So I guess on to Toby's question, which is the extent that Flank would play in the event of non-repayment. So this is something that we've actually gone really, really close to our users to identify what they're using already in the event of non-repayment. How could we be better at our users? How can we offer them services that they're not employing at the moment? And the reality is that people are actually not seeking repayment because they don't know how to communicate what they need out of repayment, and people don't actually know other potential places in the community where they can get that support. So it tends to go from, for example, that person hasn't repaid me, I'm never going to talk to them again, or I'm only going to talk to like their father in order to get money back. And then if that issue is big enough to litigate over, you'll even have someone visiting you know, small community law firms to see if they can get the money back. So this issue is like, it seems really small, but then it becomes disproportionately large in terms of the problems that beset people that have to deal with them.
CJ, thank you. We've got more questions, but I'm afraid in the interest of fairness, we're going to wrap it up there. There is a really interesting question about how informal lending could be fed through to credit ratings. So if you could tackle that in the sidebar, that would be really helpful. And then also a couple of questions about whether informal borrowing should be promoted actually as a form of credit. I won't give a view on that as a regulator at this moment in time. But thanks for your presentation, and best of luck. Thank you.
Thanks, Nick.
Okay, every time we do a demo session, there's always a couple of teams that give me names that are hard to pronounce, and the next one is one of those. So I will do my best, but I'm sure the presenters will correct me. Elifinty, I believe we have up next. Over to you guys.
So hi, I'm Mason, CEO and founder of Elifinty, and I'm here with Subodh, co-founder and CDO. So Elifinty joined the sandbox to prove that there was a better way to define financial aftercare for the masses and improve financial well-being, specifically focusing on the debt advice sector. And we've personally seen the impact of debt from our own experiences as bankers. The problem is severe. Creditors are 18 billion pounds in arrear each year. And we've heard before from other speakers, like 12 million people are estimated by the FCA to be struggling with debt. The challenging statistic is that only 1 in 6 who need debt advice have accessed it. And even more alarming is that of that, only 38% say they have effectively reached debt resolution, which is 3 in 50 of every person struggling with debt. And there is no guarantee that they would stay out of debt in the long run. The impact of that on the economy is staggering. 78 billion, or 4% of GDP, according to Joseph Rowntree. According to the money charity, about 59 billion in credit card debts, and 9 million people have borrowed more for essential during the COVID. This means we could potentially see a larger impact on households and the economy going forward. With clunky case management, lack of capacity within the current industry, we believe there is a better way to do debt advice in the 21st century. We've developed financial aftercare infrastructure as a service, considering all the stages of debt journey from pre-advice to post-advice support to bring better outcomes for individuals, debt advisors, and creditors. Resolving debt effectively and in a timely manner. Improving the debt advice journey to be more engaging and efficient. And reducing losses and improving the sector's visibility on real challenges. The FCA and City of London have helped us clearly define and test our outcomes, tracking applications, reducing debt advice life cycle time, faster referrals, and turnaround. And we have, through this process, validated pre-populating the standard financial statement that can speed up the process. Dual app ecosystem is important for engagement, so validating that that's an important aspect of the journey, and that there is a huge untapped need within the industry. And I'd like to take this moment to thank the partners and mentors that have helped us during this process. I'd also like to thank the FCA and City of London because we are proud to announce a partnership with Fair Money Advice. Together, we are excited to disrupt the financial advice space with a partner that is innovative and focused on better outcomes. I want you to imagine a future where people have improved access to support, where there is greater collaboration across the industry, where experiences are better for individuals, debt advisors, and creditors, leading to financial resiliency and a stronger UK economy. Again, I'd just like to thank you for listening and for your support. I have 2 asks. We are fundraising and would love to have you part of the Elifinty journey. And we are looking for like-minded partners, debt advisors, creditors, banks, collection agents who would like to be part of this journey. Thank you very much, and I'm happy to take questions.
Mason, thank you very much. And I'm pleased to see I didn't get the name completely wrong. That's good to hear. I guess I had a question around one of the things we often hear about in the resiliency space is also the issue of financial literacy. And I just wondered how you guys were thinking through the provision of advice and information in a way that overcomes what we know to be a problem, which is relatively low financial literacy generally in the UK. So have you guys been thinking about that, and is there something about your solution that helps address that, I guess, that gap in competence or knowledge? Thanks.
That's a great question. And, you're absolutely right. Literacy is a huge part of the problem as well on the consumer side. And, from our perspective, we are planning from a long-term delivery of our solution to include within the consumer app, financial literacy, bite-sized tools and information nuggets that help people better navigate through debt, account management, financial management. And so, those are to come. I can't talk too much about how we're planning to deliver that, but you will see that hopefully coming out within the next year.
Thank you. Interesting question from Chris about those that are not, I guess, mobile connected currently, and whether you have looked into how to cross that digital divide or how to provide these sorts of services to those that are not quite included in that way at the moment.
Yeah, absolutely. I mean, from our research, from our target market, about 70% of people have access to smartphones. Of the 30% who don't have access, we have actually looked into providing non-digital solutions. And so we're in talks with some charities to think about potential future of looking at providing mobile solutions, so mobile devices with plans and Elifinty app and other challenger banks all bundled up as a service for those individuals. And of course, there should be some training, etc., also involved. But that's, again, a future plan. For the immediate future, we want to solve the capacity issues within the debt advice space, which really needs resolution.
Thank you. And then a question from Yuval, if you could bring this alive a bit for us, what do you think good financial aftercare actually looks like? What would consumers experience? Can you give us a couple of examples?
Absolutely. So, I mean, if you think about a consumer journey itself, right? I mean, for most people, it hits them hard, and there's some shame factor involved with accessing debt advice, for example, or even going to people with a request for support. And so what we're planning to do within this is first of all to tackle the pre-advice space, where there's a lot of identifying happening on key factors that potentially could put them in difficult situations, and try to avoid those before their credit scores or their debt takes a hit. In the advice space itself, it's about automating and accelerating the journey itself. If you think about from an existing debt advice journey, an individual will get connected to a debt advisor who will then set up an appointment and go through and build a standard financial statement. And this process can take weeks. And so what we're trying to do is reduce that to days, if not minutes, and then try to go to the next stage, which is looking at the advice part of what they can do, and then connecting to the creditors, which can take several weeks as well. And what we're trying to do is reduce that time on the other side to be within days or minutes as well. And so hopefully what you will see is a better experience from a customer's point of view, a person who's seeking debt advice, first of all, trying to not get them into debt advice. And if they do get into that space where they need debt advice, connecting them quickly, getting them the right advice, being able to move to a different debt advisor without losing any traction, and then also connecting with creditors in a meaningful way for resolution. And from a creditor's viewpoint, it's about ensuring that they are receiving, clarity and visibility through the entire process, and also having better recoveries. If they have better data on the affordability and what's happening within their customers' accounts, etc., I'm sure that they would be more willing to see that, for example, giving breathing space and other aspects of regulation that's come into play would be easier for them to decide for which customers, which aspect of debt advice or which aspect of debt resolution is best. So I hope that answers that question.
Indeed, thank you very much. There is a question from Toby in the sidebar, if I could ask you to take a look at that after this, but unfortunately we've run out of time. One thing I was going to reference though, you talked about stigma of debt, and it just strikes me we haven't yet normalized the conversation about debt in this country. We made really good progress on things like mental health, and patrons of mental health that have come out and said, let's talk about this, we all experience this. I'm struggling beyond the Martin Lewises of this world to think of people that kind of come out and evangelize the need for this discussion. So I think that whole point around stigma is a really interesting one. So thanks for raising that as well. Thanks for your presentation, Mason.
Thank you.
Okay, next up, we have an entity by the name of Automated Regulatory Reporting, or ARM, although I do think that acronym might have gone already. So we might need another abbreviation, but over to you guys. Thank you.
My name is Ignacio, and I'm the CEO of Automated Regulatory Monitoring. To give you a little bit of background about our platform, we have developed a platform that automates compliance and quality assurance monitoring for financial institutions. So dealing with vulnerability adds complexity to how companies should treat their customers. It impacts companies across different industries, products within the same company, and even how these companies should treat their customers. And digitalization will make it even harder because companies will lose proximity to the customer. So over the years that I've been working in financial institutions, monitoring compliance, I have realized that most of their controls are manual, and 50% of the time is spent on manual tasks. Also, their controls are based on random samples that missed issues as simple as sending periodic notifications. And finally, it takes days or even weeks to identify the entire population of customers impacted. So we have built a platform that oversees the entire portfolio daily to identify those potentially vulnerable customers that are not treated with the appropriate levels of care. We use different available data sources to identify vulnerable customers, and data analytics and artificial intelligence to identify signs or potential signs of vulnerability that will go unnoticed otherwise. To give you an example, for instance, atypical expenditure trends. So we classify those signs of vulnerability into different characteristics and monitor the customer journey depending on each individual characteristic. So let's pretend we are having our early morning coffee and we have to oversee our portfolio using ARM's platform. So we have a high-level overview of the portfolio where we can see the vulnerable customers identified, how it changed over time to see if our performance keep improving or we keep identifying different vulnerable customers. We identify 11 vulnerability characteristics, although we're focusing on financial difficulty based on the data that has been shared during the Digital Sandbox. And we can look at the portfolio to gain some insights. So to give you an example, it seems that in this case, most of our vulnerable customers are in furlough. So it seems this should be a temporary shock. And finally, we can see different key actions that should be taken and those actions that are at risk. Ideally, cases at risk should be at 0. And to give you an example, we have identified more than 70 flags that can be activated across different companies. We can always filter and look for other reports and go to the detail and see all the details about vulnerable customers. Even we can filter to look for those customers in furlough and send this report to the appropriate areas to start investigations. We can also look at the cases at risk. We have this number of cases at risk today. We can take a look at trends to make sure our performance keeps improving. and even look at the different flags that we have identified. More importantly, we include how long these flags have been activated to maybe prioritize those that have been there for the longest period of time. And again, we can always go to the detailed reports and send these reports to the areas that should start the investigation. So after all the years of experience of our team, and after several conversations with more than 20 financial institutions, we wanted to keep looking at the industry to validate our flags. So we took a look at the FCA's final notice to Barclays, and we identified at least 22 compliance-related flags that would have been identified by ARM, giving a full overview of the performance progress, saving millions of pounds in auditors and internal manual reviews, and preventing the impact on several millions of customers. And remember, all that just while enjoying our early morning coffee. So we're looking for financial institutions that would like to, or that will be interested in our platform to either perform policy and procedures gap analysis, portfolio auditing, or even to monitor continuously their portfolio of customers. Thank you.
Ignacio, thank you. I had one question, and there's one in the queue. There's a couple in the Q&A. I guess my first was, you've given us a really good overview of how the platform and the tool identifies risks. Do you think there's enough clarity on what the actions and the mitigations and the next best actions that ought to be taken are, or is there a sort of a further limb of the platform to develop that part of the feature or that functionality?
So, well, there are we identify two types of flags. Some flags are rules that we have mapped through the regulations, and that should be clear cut. You should take those actions. Then we have mapped a lot of guidelines, trading bodies studies, and best industry standards to come up with some guidelines to provide to potential customers. Those guidelines are just, like a support for these companies to make sure that they are following the industry best standards. And also we can actually modify them to adapt to the company's risk aversion.
Okay, thank you. That's helpful. There's a couple of questions that relate to disclosure of vulnerability characteristics by customers and whether your platform requires that they sort of self-declare certain issues, be that furlough, be that distressed income, whatever it might be. But is it relying on those notifications from customers, or is it extrapolating that event or that risk from the data? Sorry, I don't know if I explained that very clearly.
No, I think that, yeah, you explained it good. So again, there will be two cases. There will be financial firms should record certain information that has been provided by the customers. So yeah, in certain cases, we take information that has been provided by the customer. In some other cases, like expenditure trends, customers in furlough or distressed income, we have a machine learning module and predefined rules to identify those cases.
Okay, great. And then the other point, and we saw this, we ran a tech sprint on mental health. And one of the things that we saw in that sprint, and one of the questions relates to this, is there are certain scenarios where systems will detect certain types of vulnerability that may not have been disclosed by the customer. And it may be a mental health issue or a capacity to make decision type issue. But then it throws up all sorts of complex moral and ethical questions about how does the firm engage with that, and how does a firm notify a customer that they might have spotted this issue. Have you guys been thinking about those sorts of things? I know you said obviously the data asset was very much focused on financial resilience. Were there other sorts of vulnerabilities that you've been thinking about?
Yeah, well, the demo is focusing on financial difficulties, but we take into account other vulnerability characteristics. And actually, during the during the pilot, one of the questions was exactly that. So we're going to compile certain information that might be a little bit intrusive on the personal life of your customers. So that's like the approach should be outside ARN's scope. But I think the best advice that we got from the Money and Mental Health Policy Institute is to ask open questions, turn the situation into positive. So instead of saying, okay, it seems that you have mental health issues, you can always say, we have additional information if you have any problem or you're finding some issues in your personal circumstances, or even submit notifications about other types of support, because people with mental health issues, apparently they have a hard time explaining their situation by phone. So sometimes it's even better to provide the information through different channels.
Ignacio, thank you very much. Automated Regulatory Monitoring is the team name. There are a couple of questions in the sidebar as well, if you wouldn't mind turning your attention to those when you have a moment, but thank you for your demonstration and the Q&A.
Thank you.
Next up, we are approximately halfway. I think that was the 5th demonstration. Next up is a group called Amplifi.
So good morning, my name is Minesh Patel. I'm CEO and founder of Amplifi Global. Thank you very much for your time this morning, as well as thank you very much for the Sandbox team for putting on the event today, and also for the last 2 months and the help they've given us. So Amplifi is an innovation. We help internal legal teams simplify the language of their legal documents. We help customers better engage with complex information. We assess the level of understanding and risks associated with that. And we provide auditable MI data, so management information data, for compliance weaknesses, potential sources of complaints, and enable a firm to provide a better duty of care to their customers. So we came into the Sandbox with 3 kind of very specific objectives. The specific case identified for our participation in the Sandbox was focused on the self-service solution that sits within the intervention to prevention space, and provide a dynamic digital solution to more effectively engage customers as part of the collections process, both for the private and public sector related debt collection at a level of complexity they are best able to understand, and assessing their comprehension of the information presented to them. So first of all, our first objective was to utilize the data sets that were made available to help develop and test our engine. Secondly, we wanted to reach out to organizations within the Sandbox as well as stakeholders and look at potential collaboration. And thirdly, we wanted to receive feedback on the Amplifi process, as well as gain insights to challenges faced by firms. So how did we utilize the resources within the Sandbox? We deep dived into the data sets. So this included the synthetic data sets, as well as other transactional data sets and SME data sets. We engaged with other innovators within our cohort, including a number of innovators where we've got live conversations going, and seeing if there is a future opportunity to collaborate. And we also reached out to a number of mentors who provided the expertise to help with our product development, such as Money Mental Health Policy Institute. Now, our primary objective was around data sets. And unfortunately, we found some limitations within the data sets. I mean, synthetic data only goes so far, and we needed to have access to data sets that showed real spending, that had vulnerability markers, as well as combining vulnerability markers with spending habits, and ultimately providing a single view of customers. I should note and say a big thank you to the Sandbox team, because we went back to the Sandbox team with a long list of other different types of data sets that we know have been used in other different types of competitions. And and developed by other entities, and they tried their hardest in trying to source these data sets. So thank you very much, and we really appreciated the effort that you went through. So how did we overcome these challenges? So first of all, we went back to the synthetic data set, and we stripped back the synthetic data set and augmented this with additional transactional information from other data sets. We identified vulnerability markers from research papers, such as the FCA occasional paper, as well as papers from the Money Mental Health Policy Institutes. We then layered the markers down onto the original synthetic data set. And this enabled us to create a secondary synthetic data set, which we were then able to use. So what are our achievements? I can say, first of all, our biggest achievement was the challenging data sets, and it made us think about our methodology. And with us not being able to have the right type of data sets we wanted, we had to deconstruct the process and reconstruct it, which kind of gave us quite a insightful insight and unique insight into other data sets that we could possibly use. And we now have a baseline model which we can evolve as we further develop the Amplifi engine. We've built strategic partnerships, and we're talking to Step Change about collaborating on a number of work streams. And finally, being in a sandbox has enhanced our reputation, built credibility, and opened doors for us. So what are the next steps? Well, in parallel to being in the FCA Digital Sandbox, we are also in the Law Tech Legal Sandbox. And the FCA Sandbox has given us a really good, strong foundation where we can take our learning and our baseline model into the legal Law Tech Sandbox. And we're building a significant corpus of legal information to help develop our NLP engine. And we've been approached by telco giants who have given us over 200 contracts. So this kind of shows the breadth of use cases that we can use our engine to. And we're looking to bringing in firms into these work streams. So we're developing our novel engine. We're looking to launch POCs and pilots at the end of March and looking to deploy Amplifi in that environment with a focus on consumer credit and the debt collection space with our partners that include Equifax and their sister company TDX and Indesa. And finally, in April, we will be publishing a report focusing on the firm's legal or regulatory obligation to the customer in identifying vulnerability and also some specific legal questions concerning the legal purposes of T's and C's and their role in informing the customer, the legal extent to which legal text can be simplified and retain their integrity. We are working with Mishcom de Rey on the report, and we will be informed by our workshops with regulators, trade associations, and data and AI experts and institutions as part of our work stream in the Law Tech Legal Sandbox. Thank you very much for your time, and thank you again to the Sandbox team for this opportunity.
Minesh, thank you for your presentation and for sharing the good, the bad, and the ugly of your experience in the sandbox and the bits, the limitations and challenges you faced. It's helpful for us as we think about how to develop this further. I guess I had a question about what you thought a sort of simplified terms and conditions might look like. So this has been a long-standing issue in financial markets and in the legal profession generally. This balance between disclosure, clarity, transparency, brevity. And it sounds like you're developing an NLP engine to help come up with a more simplified, appropriate form of disclosure. Can you share anything on what you think that would look like and the characteristics of that?
I can't share the technical process as to how we're doing because that is very novel.
Sure.
But what I can share is that I'm a marketer, and being a marketer, my number one priority is to engage with people and to customers, whoever I'm sending that information to. So therefore, if we present information that people do not understand, it doesn't matter how many times you go back to that individual for different ways of presenting the same information, that person is not going to engage with it. So first and foremost, you need to make that information understandable, but obviously within the parameters, within the legal. So we're working very kind of closely to see, well, how far can we simplify language before it loses its legal context? That's first off. Secondly, you have to put them through put them through a user experience and interface that they're more akin to. And so therefore, as people have mentioned previously, bite-sized information, but also what we're doing is we're layering that up with multiple other different functionality. So, and thirdly, people need a reference point. I've been looking for API, so information about my credit card accounts, and you won't believe how long it took me just to find simple information that I needed to find. And what we're doing is actually making a hub which has a reference point, so the individual can go back in and access that information. So it's about kind of looking at the whole kind of process, bringing the T's and C's to life, and it's not just there as a one-stop shop at the start of a onboarding journey. It's there for the whole duration, because what we want to do is use that T's and C's as a reference points, and those T's and C's will change over time, because if you miss payments, you go and have a payment holiday, interest rates changes, etc., etc. So therefore, the individual customer in some ways needs to know what the account information is and how that is changing as well. And we're presenting that to them and giving them the opportunity of accessing that.
Thank you. We're running short on time. I appreciate I asked a very long question. There is a question from Chris in the side about the fact that a lot of vulnerable people are themselves not that familiar with the extent of the digital footprint they're creating and the amount of data that is being mined about them. And yet a lot of these solutions rely on access to and utilization of that data. So how do you think through the kind of the consent issues and the informing the customer they understand?
That's a very good question. And one of the pillars of Amplifi is that we are being very transparent, and we will have a consent and a privacy notice hub within our main section. And this is where the individual is and will be able to access all the different types of data that we're holding of them, and have control over that data. And we are very upfront. We are monitoring this data, we're capturing this data to provide a better service to that individual. And then also on the flip side, for the lenders, giving them an intelligent audit trail to start intersecting and feeding bits of information, just to ensure that we need to ultimately be trying to increase that level of financial literacy for the consumer side, but also give the lenders the tools necessary to be able to do that.
Yes, thank you very much for your discussion. Good luck with the patent discussions as well. And thanks for talking to us today. Appreciated.
Thank you.
Next up is Portabl.
There's been some big stats thrown around already this morning, and here's another one for you. Our interest is wholly and solely in the future of work and how that's going to unfold and impact society. And the headline stat here is, 50% of the world's workforce are soon to be, if not already, working independently in some shape or form. Independent, freelancer, gig, consulting, contingent, flexible. This is a big headline statistic. And we're thinking about vulnerable consumers, the impact of work, it's a hard connection into that vulnerability. So 50% of the world's workforce are working outside of the typical, normal, supported employment structures of the old world. And who are the people that are living and working as part of this freelance or gig economy, if you like? Well, it's everyone, and it's happening now, from millennials to baby boomers, everyone in between, across all walks of life, all shapes and sizes. So by default, we are all now living and working in this freelance and this gig economy. And let me share with you an insider's secret and your first hashtag opportunity today for those social media aficionados. This gig is big, to the tune of 1.3 trillion US dollars at a global level. As I said, it's a global market phenomenon and a fundamental shift really in the way we are choosing to all work and by default live. And that's an important characteristic and distinction as well. Once upon a time, freelancing independent work wasn't by choice. It was forced upon people. But more and more, that force is still there, and no doubt COVID is going to accelerate that. But by choice now, people are demanding this sort of independent, free way of working and living. And who are the people? And that 50% that we're talking about, where are they placed? How are they going? Well, for them, the risk is even bigger, because a staggering 74% of them are either uninsured or chronically underinsured, and just focusing on insurance here, by default, facing huge family and financial risk every single day. So I'm Mike Manette, the founder and CEO of Portabl, clearly smiling there. So that was pre-COVID team photo. And we're all about driving shift and understanding into this new paradigm. And fundamentally, this is the problem. As I said, when you've been that full-time employee, you've got everything provided for you. Something happens to you, your family, support structures kick in, services are made available, and it's all designed to look after you, to keep you happy, healthy, and productive. The day you go out on your own or you start out on your own, you've got absolutely nothing. And you have to start thinking about and putting some of these things back into place. Some do, most don't. Head in the sand, hoping it's all going to go away, deciding to run the risk. The second factor here is when you've been that full-time employee, your underwriting score sits here and your credit score's here. The day you go out on your own or start out on your own, your underwriting drops and your credit drops for no good reason, except that you are now independent. And these are the sorts of dynamics that we're looking to explore and to challenge. How we're doing that? Well, we've developed what we think is the world's first risk score. It's been likened to the universal credit score for the freelancing gig economy. We're calling it FRISK, freelancer risk. And that's what brought us to the sandbox opportunity. As I said, we're on this mission to support the vulnerable workforce and those who are exposed without the safety net and structures of traditional employment. Be it benefits, access to cover, favorable terms from your banking or your credit facilities, or stuff that works for you in this flexible day and age. When we came to the sandbox, this is what we started with. We had an idea, and that was about it. Even worse than that, it was a blank piece of paper around that idea. So for us, it was a great opportunity to get going and to really start thinking a little bit further and a little bit deeper. We wanted to utilize, like everyone, the available data sets to start extracting some data and analytics and intelligence across the sort of the standard issue risk metrics, if you like. But also what's being touched on today, and we think it's also important, are these behavioral and social sort of dimensions that we'd like to bring into it. We're wanting to get away from those things that force the computer to say no. In our world, the world of work, independent workers, behavioral characteristics, there's some positive things going on there, be it resilient or tenacious or trying to, they have to hustle to find work, to keep work. And some of these personal characteristics can be quite favorable, and even when matched up against the traditional sort of more secure employee. As I said, we started with nothing and we got busy. There's terms on this page and bits and pieces that I don't understand, being old school, but we've had some bright young people really utilizing the tool sets, the information, synthetic data made available. And at the end of it, we've come up with our draft model. So we've gone from a blank piece of paper to a draft model. And for us, that's fantastic. It's actually inspired us now to push on. As I said, we're 100% focused on developing that understanding of both the good and the bad risk that comes with being a freelancer. FRISK is the score that sits at the heart of the platform that we're building. Everything we're doing is designed to empower that independent workers. So if you like, we're looking to take back, challenge the old world, present this new risk score, and work in partnership with the sort of the insurance companies and the financial services providers to truly understand that independent worker risk. And by doing so, it ultimately benefits the individual, their family, and society as a whole. More inclusive, more social mobility, less precarious situations is better for all of us. Our asks of today, there you go. We're an early stage startup. We're always raising, and we are just kicked off our second raise. We're interested in working with financial partners who understand and believe in this future of work concept and the way to do things better and differently. Also now we're encouraged by our early findings. We want to push on proof of concept pilot partners looking to collaborate further with this understanding of the risks both good and bad, that the freelance economy, the gig economy is presenting to us all. And already today I've heard there's probably some friendly, freelancer friendly, if you like, products and services that are in development. If you've got stuff in development or stuff that existing, as I said, we're building this platform and ecosystem all designed to support that independent worker to live more freely, safely, happily. And ultimately our mission is to enable people to sleep better at night. No need to remind you, this gig is big and we are Portabl. Thank you for today. Thank you to Toby and Teresa for keeping us accountable, to the ecosystem for checking in on how we're going and offering their help and support. And hopefully it's not over. We look forward to collaborating, as I said, further and helping each other out. Thank you.
Mike, thank you very much. From Trumpian orange to hot pink, a real colourful presentation. So thanks for that. I guess my question was around, the development of a new credit score or a risk score. Sorry, not credit score, a new risk score, and how you build a community that trusts in the accuracy and the validity of that score. Just any of your thoughts about how you'll take that piece forward?
Well, absolutely, you nailed it in one. Trust is probably our most important pillar that we need to establish. So how do we do that? I think our approach is we're just putting that individual at the heart, establishing the understanding, the rich understanding of the way that they think and the ways they go about it. And then, the ambition is for that understanding to be shared back to all the constituent interested parts. It's not to challenge industry or to tell them off, but it's actually to take, I'll say, poorly understood risk and present it back as much better risk than what they first thought. So therefore, it's good for them to get access to better risk. It's highly fragmented, so that's where the understanding often falls over. So being able to take that consolidated view is actually helpful to industry and creates for more efficient win-win. We've got 3 wins: win for the individual, win for industry, and a win for the wider society. But trust is integral. And I'm going to say it's a work in progress to how we establish and maintain trust.
Thanks. I had another question actually around, you spoke early on about how, to some extent, how important employers are in providing an elevated risk score, or a beneficial risk score, an underwriting scenario and a risk scenario for colleagues. And I just wondered how many people realize that, to be blunt. Like, how many people actually understand that it isn't just whether I pay my credit card on time, it isn't just my actions, it's also some of these safety nets that are built around me because of my employed status. And I've probably banged on about this quite a bit already today, but this question of literacy and understanding, like, what do I impact, but also what are the things I'm benefiting from around me. How do you think we disentangle some of that and bring some of that to life for individuals?
Well, the big discovery is, for those who've been in full-time employment, all of these things that are made available and provided to them are often taken for granted, not considered, and until such time as one they're called upon, which isn't that often necessarily, or on their own and realize, hang on a minute, I had things like critical illness or income protection, life insurance, access to benefits with health and dental that my company used to provide for me. How do I go about now finding out what I've got to do to get after it? And then the second layer to that is, well, in the old world, the company benefited from what they call group risk. So they're able to get group buying power, if you like. In this new world, when individuals go out and try and sort this stuff, they're being penalized. They're facing penalty, and certainly on a pricing, they're now paying one-to-one pricing at a high street level. So, the same thing, it actually falls back. There's a win-win-win for the organizations who are either employing or have access to well-supported either full-time employees or contracting and contingent, because at the end of the day, the happy and healthy the individual can be, the more productive they can be, which provides benefit in that sort of circular way.
Thank you, Mike. I'm sorry, I asked questions because they were a bit slow to come. They have now come, but we're now at the time. So I'm going to ask you to pick up the questions in the side. I also ask all the attendees, get your questions in early because I will fill the space, but you'll probably have better questions than me. Mike, thanks for your presentation and good luck with the tan. Take care. Okay, next up we have applied blockchain. Indeed.
My name is Adi Benawi. I'm the founder and CEO of Applied Blockchain. And I'm going to present to you a product that we're launching called Silent Data. So we've heard today a number of different approaches to dealing with vulnerable consumers. And the area that we focus on, it's quite interesting actually to see how everybody looks at it from a slightly different angle of how they can help. The area that we're focused on is data. And actually the fact that the data representing these people is actually very sensitive, and transferring and transmitting and sharing that data is in itself an issue. So when vulnerable consumers are being assessed for credit, we really need to think and maybe rethink about how that information is shared and whether it should be shared in the first place. So why not share data? Well, those of you who watch the news will be aware that every week there is another breach of one corporate or another. So millions of records are stolen. The data is surfaced on the dark web. It's used by criminals for identity fraud. And there's actually a separate stream of work in this FCA sandbox to look purely at the cyber issues. But we're thinking about this in terms of the vulnerable consumers and how they can be dealt with. So what's the problem? The problem is also related to open banking. So open banking is an interesting and fantastic initiative which the UK is leading in, which, as we've heard from some of the other participants here, allows inspection and sharing of banking data. So it was obviously introduced to create more innovation and more competition, which, looking at the companies today and all the other companies using open data, we can see that that's really starting to happen now. And open banking, as we've seen here as well, can be used to assess affordability, which is a fantastic use case because it goes beyond the existing credit checks that we have today and looks at other aspects of individuals and allows people to be assessed beyond simply the payment defaults that they might have in their history, in historical data. The problem is that open banking opens the floodgates to data sharing. So what we're really doing is we're creating a tunnel into an individual or company's banking data. And that's a lot of sensitive data that's potentially being shared. So what's the solution to this? So we've created a platform called Silent Data, which we believe addresses the best of both worlds. So the platform provides privacy preserving open banking. And what we mean by that is that we can undertake assessments on open banking data without actually having access to the data ourselves and without it being exposed in any way. And we believe that for vulnerable consumers, this will help protect their data and protect it from theft and so on, and potentially increase the lending to those types of consumers who might then be more willing to have checks performed on them. The platform itself offers, at the moment, we've just launched, and it offers two types of checks. The first is a proof of funds, so proving that the balance in the account is above a certain level, and proof of income, so proving that there's 3 months track record of income above a certain level. And the way it works is that requests are sent out by email, and the consumers or businesses, you can also use this to check businesses, can click through and run an open banking check. And the extra secret sauce here, if you like, is that the silent data bit in the middle, which ensures that the open banking data is never revealed. It's not even revealed to us. So it's all stored and processed in a confidential, hardware secured enclave. And this solution has now been, while we've been through the sandbox, has been ratified by one of the largest security auditors in the world, a company called Kadelsky Security. And what's produced at the end of the process is a certificate. And the certificate is a digital certificate that can be independently verified. And the certificate proves that the individual or the company has a balance over a certain level or income above a certain level, and it reveals nothing else about the underlying data, but the digital proof, the cryptographic proof, is all in there. So it proves that the data actually came from the bank, and that the check was performed on this person's or this company's own data, and that the check was performed privately and it couldn't have been revealed, and so on. So it's a new type of digital certificate that has all of those checks in place without requiring access to the data. And the great news is that as of today, we're pleased to announce that this application is live. So you can actually go to the Silent Data website, try it out for yourself. You'll be one of the first. We'd love to get some feedback. And you can run your own, you can test checks with bank accounts and see how this actually works for yourself. We've been very pleased to be incorporated in the FCA Sandbox. One of our goals is really to see how we could utilize the synthetic data to try and add to the basic checks that we have in place at the moment. Unfortunately, we didn't really get much value from it. And the main reason is that open banking data was useful in its own right, but we wanted to understand whether checks on the open banking data, how they correlate to consumer behavior. So if we think that somebody has an income over a certain level, then that shows good behavior. How well does that correlate with loan repayment? And unfortunately, there wasn't any correlation, or there wasn't the correlation that we required in the synthetic data sets. So we couldn't test this hypothesis. So the lack of mapping was a bit of a hindrance for us. But obviously this is the first sandbox, and I guess it's one of the things that would be useful for companies like us, is to have more correlation across those data sets in the future. The real value for us out of this program was the mentors. And here's a list of some of the mentors that we spoke to. They were all fantastic conversations that have led to changes in the product and changes in our approach to the market. Shout out in particular to Davara, who had a really long conversation with, John Ho, and Denise, who provided, I had two long conversations with, and provided some fantastic feedback and ideas, in particular in how this could be used to help fraud. And over here on the left, you can see some of the ideas that have been developed on the back of those conversations. So fantastic partnerships and feedback there. And the other angle is regulation. So we're going to apply to be for AISP authorization, and we're going to liaise with the FCA to make sure that the current regulation doesn't force us to take hold of and access data that we wouldn't otherwise need to. So we're going.
Hi, Addy. I'm sorry to interrupt. It's just a time check for you.
Yeah. Okay. Thank you. I'm just finishing up. Last slide. So basically, we want to help the UK and London to lay the foundations to lead in privacy preserving open banking. And we think we have all the infrastructure in place to help do that. And we look forward to partnering with others. Thank you very much.
Addy, thanks very much. Privacy preserving open banking. I like the sound of that. And it builds on a theme that we looked at last year, looking at privacy enhancing technologies generally and their role in secure data exchange. You spoke about a couple of the early use cases: proof of funds, proof of income. Where do you see this going beyond that? What other opportunities are there, or are they the two core use cases for this sort of solution?
Yeah, so actually from the conversations we had with the mentors, that opened up a few other avenues to explore as well, including around fraud and some of the requirements in place to prove source of funds. So, for example, we could ask for proof for individual transactions without us or anyone else seeing the rest of the transactions. So seeing where specific money has come, or where money has come from, without necessarily opening up the whole bank account. That's one area. The other area is I guess beyond the stream we've been looking at here is business stability. So, you know, the risk that companies have working with other businesses who may not pay them or who may not be good for payment. So the ability to regularly check your counterparts and manage your own risk, and in a way that your counterparts don't have to start opening up all their sensitive commercial data as well. So beyond consumers, we're seeing business applications here as well.
Great. Thank you. A couple of sort of more technical questions, I guess. Carsten's asked one about how this compares to ING's zero knowledge range proof, I think is the KRP. But also one of the things when we'd looked at some of these privacy enhancing technologies before has been scaling challenges, limitations on how hyperscale you can run these sorts of infrastructures given the current state of development of the hardware and some of the enabling software. Yep. Can you answer either of those questions around either scale or how this compares to ING's offering?
Yeah, I mean, these are great questions. So prior to building this, we tested some of the technologies you mentioned. And the technology we're using isn't software-based cryptography, it's hardware-based. And what that means is that we don't have scalability problems. So this solution will absolutely scale. And then the big difference compared to there's a few differences compared to zero knowledge proofs and the work ING was doing, which I'm familiar with. One is that the party sending the data doesn't have to make any changes here for us to use this platform. So you notice that we use open banking, we use the existing APIs. The banks don't have to change anything, and neither do the AISPs if we're using any. So we're able to preserve the privacy without requiring them to start adopting special software, right? Which would be required of zero knowledge proofs. And the other thing with zero knowledge proofs is that they are new cryptography that needs to be tested and proven. And we're using existing, well-established, proven, NIST approved cryptography that's well established in the financial services industry. So it's scalable and it's based on existing technology, and it doesn't require the data sources to change. So all of those put together allow us to package up a product which is just ready to go into production, and I think it's one of the first in its kind.
Eddie, thank you. I appreciate these are nowhere near enough time to discuss this properly. You have a question from Anil in the sidebar. I'd also just, if no one's mentioned it to you, our colleagues in Singapore at the Monetary Authority have done a lot of work on Intel enclave chip security. So we might be able to connect you up with some colleagues there that might be interested in this proposition. But thanks for your time today, Eddie.
Yep. Nick, can I quickly answer Anil on the 90 days? So we destroy the data straight away, just so you know. We run the query and destroy it. That's it. We don't renew it after 90 days. There you go. Sorry.
There you go. Rapid answer. Thanks very much, Eddie. Okay, into the final two. Next up, we have DirectID. We're running a couple of minutes behind. Of course, we won't cut any of the teams short. So just to let you know, we'll probably run a couple of minutes past the hour. So over to DirectID.
Hi, we are DirectID. My name is Stefanos Nikolaou. I'm the data scientist for DirectID, and today I'm going to talk to you about the POC we made for emerging financial distress. Excuse me. Okay, first of all, a little bit about DirectID. DirectID is an open banking platform that not only creates as an aggregator, but also has the ability to generate insights on top of the data they pass through our platform. Some of our products, you can see them in the screen, are based on open banking data and can provide identity checks, customer onboarding, credit risk management, operational efficiency, affordability assessments, collection and recoveries, and many other data analytics solutions. Before we talk about our PSC, we need to provide a definition on financial distress. Before we can get into details of our solution, the definition for the financial distress is the following. Financial distress is the condition in which an individual does not have the required resources to meet the financial obligations towards to disbursement creditors. The aim of this study is to create a system based on mathematical modeling and statistics, which will provide us with the probability of an individual having emerging financial distress. This idea is that can help the financial institutions get better decisions on applications. The data we selected are a very old data set, which is from real data that was being anonymized. It's from 2000s. And the reason we selected these data sets is because they consist of anonymized real clients' data. They contain loan outcomes, which can then we use to derive our insights. And they contain demographical data, and they're publicly available, so our solution can be tested by anyone in the market. Our proposed solution is to take these data sources in their raw format, pass them through our behavior analytical process we have in DirectID, which generates features which some of them are comparative, so how an individual compares to the rest of the population. Affordability features, so what is the affordability of the person, and account statistics, like how many transactions they have per month on average. Then each person will be passed through our mathematical modeling and statistical analysis, which then that tool generates a probability of the default or the emerging financial distress. Now, in the next slides, we're going to talk about the implementation of our proposed solution. The first step we did was to take the data sets and clean them. The data sets were quite old, had a lot of data format issues, and a lot of them were in Czech, which meant we needed to translate it. After the cleaning processes, we start the pre-processing of the data sets by generating all the insights we discussed earlier. There were around 190 insights we generate for each individual customer. The problem was the classes were imbalanced, so very few vulnerable cases existed in the data set. So in the pre-processing step, we generated synthetic data for ourselves in the area of vulnerable cases. Then we used all of this synthetic and non-synthetic data on our modeling and statistical analysis process, which we would try to optimize our models for the weighted recall, which means we try to make our models predict as best as they can the vulnerable cases. And then we're able to provide the probability of emerging financial distress. Here's some of our preliminary results of the proposed solution. As you can see here in the confusion matrix on the left side of the screen, from the 6 vulnerable cases we had in the initial, we picked and we took out of the training set from the initial data set, we managed to predict the 5 of them, which that was the metric we tried to optimize our engine to, which is a great result given the imbalance of the classes. So what's next after the POC? As a platform that democratizes the access to financial data, we are committed to help people in difficult situations. We are looking deeper to create a pilot for the understanding of emerging financial distress. Now, the reason DirectID can be a very good, can provide great solutions on these things is that instead of like the financial institutions that generate some sort of numerical attributes from the raw transactional data, we have multiple toolings that can generate more and enrich insights on the data, which means we can create a lot more data points than a normal financial institution. Some of them we have, a small selection is here. Daycam verification, credit debit recurrencies, categorization, merchant identification, and customer numerical attributes. We are open for collaborations. If you want to join us in our journey to improve the financial health of vulnerable people, please get in contact. Our contact details is this one. Thank you very much, and I'm available to answer any question.
Stefanos, thank you for your presentation, which is actually very quick. So you got us back on time. Thank you. My quick question was around, as one of the issues we face when we look at these sorts of products and models is the proliferation of data, the metrics, the number of risk flags, the number of indicators, and almost a sort of paralysis of an analysis paralysis, because there's just so much information that could be brought to bear and considered. How do you sort of weave through that? How do you get to what is the really crunchy, the really important metrics for firms and others to make decisions off the back of in this sea of information?
That's true. The important thing is to enrich the data in the right process in order to generate the right insights. It's not that much on what we're going to select on the modeling. As long as the data have a predictive power, and as you can see for our metrics here, our RO curve can show that our classes are very hyper separable, which means our models didn't have to do any difficult guessing. All the difficulty was in the pre-processing, so picking the right data, be very, very careful on how we'll use them, generating as much insights as possible, which in this case weren't that good because as a financial institution, we couldn't use our all arranging tooling we discussed. So we got it on the aspect of what the bank will do. And the most important metric I believe, as data scientist in these cases of very, very balanced cases, is the vulnerability, the recall, which means try to identify as many possible cases as you can that they're truly vulnerable. And if you misclassify the non-vulnerable cases, are not that big of a deal because financial institutions will have to vet it anyway. So you really, really don't want to miss a vulnerable case. So we try to hyper-parameterize our models on this aspect.
Sorry if I missed it. What were the sort of key flags of vulnerability that you were trying to sort of build the model to predict and identify? What were some of the main flags that you were trying to target?
We didn't do the explainability of the model because we didn't have enough time, like our solution was fairly big. But the main metrics we're using were so calculations around your affordability and your main income streams, like how much of that was recurrent credits, how much was debits minus credits and things like that, or what was the percentage of your debits from your total credits. So we generate around, I think, 190 features. As a next step, we'll also provide at some point an explainability to tell you what was the most important thing that resulted to tell that that person was vulnerable. But that's quite a big research for 10 weeks.
Yeah, understood. Sorry for setting unreasonable expectations of what's possible in a couple of months. Thank you. Sorry, go on.
We really want to do something like that, but yeah, it's time.
Yeah, absolutely. Thank you very much. As with all of the presenters, if there are further questions to ask in the sidebar, please feel free to do that. But otherwise, for now, Stefanos, thank you very much. And thank you to DirectID.
Thank you very much.
Okay, on to our last but not least, Kalgera.
Well, thank you. And hello, everyone. My name is Chrissy Corafa, and starting off, I'd like to make two observations in the context of the pandemic. Firstly, there is a real debate and discussion, and also as part of the FCA sandbox, which we thank, how we care about the vulnerable in our society. And secondly, I would like to remind you that there is a small group out there who are preying on the most vulnerable, who could be our parents, dear friends, who are susceptible to financial abuse. So it is up to us on this call to make sure that we take all the necessary steps to prevent this from happening. So I'm Chrissy Corafa, the CEO of Kalgera, and I will tell you today what Kalgera is doing. At Kalgera, we help financial institutions interpret their customers' behavior to protect them against moments of vulnerability. Why is this important? It is important because we all want to build a financially inclusive, safe, and caring society. From the FCA's own research, nearly 1 in every 2 of us will be in some form financially vulnerable in the future. What that means is that at any time, nearly 50% of financial institutions' customers are at risk of experiencing fraud, scams, or mis-selling, costing their household on occasion up to £300,000, potentially financial institutions millions, such as the £64 million fine last year that Lloyd's had. I told you why this matters to us and what is the problem, and now I'm going to tell you what Kalgera is. Kalgera is a RegTech platform that enables financial institutions, specialists, to interpret the financial behavior of their customers to keep them safe. During the FCA Digital Sandbox, Kalgera used data sets to develop a complete set of anomaly detection models and improve its algorithms that help financial institutions to identify their customers who are at risk of financial abuse, provide them with a list of transactions that drive customers' vulnerability risk, and enable them to analyze customers' vulnerability cases using drill down capabilities to transaction level. Let me tell you how we do that. We do that in 3 steps. First, the platform retrieves customers' transactional data from payments or card transactions. We then flag events indicating vulnerability driven by underlying processes based on our financial abuse framework that we have designed and through deploying our algorithms that we have built. And lastly, we demonstrate the analysis on a dashboard with additional capabilities for financial institution specialists to simply and easily understand their customers' behavior to take relevant and timely action. This solution enables financial institutions to automate manual processes, to better manage their vulnerable customers and potentially increasing their customer base, speed up their investigation time, saving money and resources, and also help to get them ready for the FCA regulation, ensuring that the most vulnerable are protected. Now let me tell you how our product is differentiated. We interpret our customers' financial behavior to safeguard them against financial abuse by using a novel financial abuse scenario approach, which is based on neuroscience and decision-making capacity logic and AI techniques. The interpretation of the data is a result of numerous underlying algorithmic models that we also have been developing during the FCA Digital Sandbox, and the results are presented on a dashboard. This allows financial institutions to drill down into the causes of customers' vulnerability and understand the underlying drivers. Now, our next step is to do proof of value pilots with financial institutions to help them better quantify how many of their customers are at risk of financial abuse, help them understand where efficiencies can be achieved in the vulnerable customer management process, and also quantify the benefits so that they can choose if wish to scale up with our product. Our experienced team is here to help you manage this process, and we enable financial institutions to be more sophisticated to define, identify, and support their vulnerable customers. This is both a win both for customers and financial institutions, and we believe now is the time to take concerted action. I'd like to ask to get in touch at partnerships@kalgera.com. My name is Chrissy from Kalgera, and I would like to thank you all for listening. Thank Toby and Teresa for all their support, the FCA team for organizing this, and the mentors who have supported us during our time with the FCA Sandbox. Thank you.
Thank you, Chrissy. Interesting presentation, and thanks for hanging on to go last. Always a difficult slot. I was just going to ask again. It's a bit of a bugbear of mine, but this question about explainability. So obviously, you said your solution combines clinical neuroscience expertise and a mixture of AI techniques and advanced algorithms. How do you, one of the things we hear a lot from big institutions is we won't implement something that we can't explain. Because we know that you as a regulator will take a dim view of us if we do that. So how do we collectively work through that challenge of explainability, transparency, and how do you think your solution can be explained in a way that people can trust and rely on it?
Yes, so there has been a lot of research also from the founder is of Kalgera, Dr. Dexter Penn. He has done a lot of research on financial decision-making capacity, and there has been like initial frameworks and logic and some explainability on how people make decisions, and it has been found that can be reflected on the seasonality and the patterns of financial transactions. And so we took, we were part of the data sprint in the summer, and we understood that talking about financial vulnerabilities pretty broad. There are many use cases that fall under financial vulnerability. And we felt that we could have the capacity of determining financial abuse, because it's also linked to the experience that he had as a doctor. Many of the patients that had poor financial decision-making capacity would also experience financial abuse by being more easily scammed or defrauded because of the poor capacity of making the judgment that this is a potential fraud or scam. So it made sense that we focus on financial abuse, and this decision-making logic was also embedded in the way we interpret the data and the way we have been developing our models to see it from different perspectives.
Thank you. That's very helpful. A couple of questions in the sidebar sort of overlap with one another. You know, what is the data that you're using to identify vulnerability, and how do you define that? So if there's anything you can add on those, I don't know if you can see those questions.
Yeah, so as part of the Digital Sandbox, we would use the check data. And we had also previously some synthetic data, which was mainly transactional based. Yeah.
Lovely. Okay, we are out of time, I believe, unless there's any final questions. I'm going to give everyone 20 seconds and then we're going to close out. No, going to leave it there. Chrissy, thank you very much for your presentation and for your time today. Thank you to Julian, Craig, CJ, Mason, Ignacio, Minesh, Mike, Addy, Stefanos and Chrissy for their presentations and their discussion with you all today. Thanks also to Teresa for keeping us to time. I'm sorry I've gone over by a couple of minutes, and for keeping everything running smoothly, and for all of her support. Actually, many of the teams mentioned it, Teresa's support over the past few months. So thank you very much to Teresa. Likewise, I'd just like to thank Toby Whitlock from the FCA, who's been a real leader and stalwart of the Digital Sandbox and has supported many of the teams. So thank you also to Toby for all your efforts. If you'd like to engage further with any of the teams, please do so through the Sandbox website or through the contact details that those teams have shared. There will be videos of all of these showcase sessions from today and yesterday, and indeed tomorrow's one. They'll all be uploaded onto the Digital Sandbox website very soon. We at the FCA and the City of London Corporation will be evaluating and considering how to take the Digital Sandbox forward. There's been a lot of useful feedback from the teams about the features that have worked well and those that perhaps require some refinement and development. But if any of you that are on this call today would like to play any sort of role in a future cohort of the Sandbox as an advisor, a mentor, a provider, or any technical assistance, we'd be very delighted to hear from you. For now, though, thank you all for joining us for a couple of hours this morning. I hope it's been an interesting session for you all. Stay safe and have a pleasant day. Thanks, everyone.